Welcome to Dennis Money's 2 Cents, your weekly recap of headlines and stories. I am Matt.
I'm Victoria.
And I'm Rabih.
Yo, guys, we are a little late today. That is my fault. It has been a travel day. I just got to the poorly lit hotel room, as you can tell here. And I don't even know what we're talking about. So sorry. Okay, I do sort of. But
Rabih
yeah,
and I are like, what?
Robbie's like, I hope you do. Okay, I somewhat do. But again, I've been traveling all day. I'm in California. So we're a little bit late. So I do know what we're talking about. 3 things on the agenda. We've got a market update, of course, from Rabih. We're going to be doing talking 4% rule and maybe teasing Victoria, a little segment we did with Dave Ramsey. I think it's a good time to maybe tease that a little bit.
Oh, she's posted.
Did you post it? Okay, we're going to talk about that.
Oh, is that a bad thing?
No, I love it. I didn't know you posted it.
The short fear in your eye kind of scared me.
No, I love it. And then Victoria, of course, our study buddy, has more discussion around retirement specifically. So let's jump to Rabih. Let's talk market and economy update.
Yes. So last week I told you I don't know what I'm going to be talking about because not a lot of data is coming
Your
up.
tease was I don't know what we're going to talk about.
Exactly.
And then you said it.
And then I said, I don't even know what we're talking about. So there you go.
Self-fulfilling prophecy.
Yep.
So
There you go.
In a life-saving manner, the CPI reports were released today, so I have something to talk about. And what happened is that the CPI, as we've always mentioned, is the inflation indicator for a basket of goods that indicate what the overall price levels are for commodities and stuff consumed in the economy. And for the past couple of months, it was actually heading in the wrong direction. So to give you some reference, headline CPI, which includes everything, including food and the gas prices, was at 3% in June, which was the lowest it ever got to. And then in July, it went up to 3.2. August went up to 3.7. September was also 3.7. And that kind of coincided with like the batch of bad news about the economy not slowing down as fast as we want, and how the stock market for the past 3 months was selling off in a sense to adjust for higher inflation and interest rates higher for longer. But in a spark of good news for the stock market, not good news for the economy, inflation for October came at 3.2. So it dropped from 3.7% to 3.2 on a year-to-year basis, right? So this came as good news. Actually, the stock market today jumped around 2% on the S&P. Small cap value is up 5% in one day. Like a big boost to this economic narrative that, yes, the Fed is in control of inflation. There was a bump due to summer spending, but now we are on the back.
Soft landing
to the overall trend. And usually in weeks when there aren't really a lot of economic data and the market is just moving due to supply and demand, I like to zoom out and take that as an opportunity to look at like what has happened year to date and how is everything fluctuating. So we know that inflation has been trending down all the way towards 3% on the headline. The core is at 4%, but it's making new lows every single month, which is all heading in the direction of the economic narrative. The inflation is getting under control, but job is still not done. But as a result of that, as of today, the S&P 500's year-to-date performance is around 18%, which, you know, given all the negative news, it's a pretty good return.
Did you say 18?
1.8, yes.
Okay.
Wow.
18%. So in a sense, we would want to look and understand what is driving that return. And we haven't done a sector breakdown since the days of NVIDIA, and, you know, it was all over the news. So if you want to split those 18% come from the S&P 500, is it 18 or did I misspoke? I see you looking at screens.
No, I'm looking at the screen. I'm looking at the doc that you created.
Oh, okay.
Or that you put. I was just trying to follow along, Rabih.
Yeah. Year to date, it is.
I wasn't questioning you, Rabih. Don't.
I felt some judgment in your eyes.
Rabih was so nervous. He's like, "Are you questioning
the
me?"
first time
You made Rabih second guess
nervous
himself
on the podcast. But here you go, Matt. I just pulled up my dashboard.
No,
It's
Rabih, I was
64%.
Rabih, I was never questioning your numbers. I was literally wanting to just follow along. I wasn't pulling up Google.
You
but
should
I
know better
believe
than
you.
to question Rabih at all.
I'm not.
Wow.
Don't come at me with questioning Rabih. I was not questioning Rabih. Okay, Rabih, back to task. Let's talk about sectors.
Back to sectors. So the S&P 500 went up 18.64%. And I really wanted to know which sectors actually drove that performance. And yes, going to the sheet we're all looking at.
Yes,
the
not Google.
The biggest performer for the year has been the technology sector with like 47% growth. And the worst performer for the year has been utilities, dropping almost 10% for the year
Wow.
to date. But if you actually look at it, you've got technology, communication, and consumer discretionary. The year-to-date return is 47%, 45%, 30%, respectively. And then all the other sectors, we're talking industrial, material, financial, real estate, energy, consumer staples, healthcare, and utilities, all of them returned below the 18%. Like the highest of this other batch I just mentioned is industrials with like 8%, which is 10% what the market did. And this just tells you that the market is a weighted average of all of these different sectors. And it just happened that the sectors that are the largest in the economy also happened to go up, and they lifted the index overall. So although the market is up 18% and the economic narrative is telling us that there is an overall slowdown, if we zoom in, there's only 3 sectors in the economy that are lifting financial assets up. Otherwise, they're just going sideways or slightly going up or down. And this is, a very important piece of data to try to kind of find a middle ground between the stock market narrative that keeps doing well this year whenever slowdown news shows up, and the economy that is definitely on a trajectory of slow growth. So here's what I will leave you with today.
So I'm curious about this, Rabih, of just how normal is this of like these like 1 or 2 or 3 sectors driving the market? Like, so I guess tell me if I'm wrong. I interpret this as like, this is pretty normal that like certain sectors in the economy drive a lot of the growth, right? This is why we believe in diversification, right? But I also hear on the other side of this is like, people want to make this sound like this is so abnormal right now. But what is your take on that? Like, again, how normal is it that we have 2 or 3 sectors driving all of our growth right now?
It is very normal that we have a couple of sectors driving the market. The gap in the performance
is what's
that
abnormal.
You would look at. Like usually during COVID days, a bunch of sectors, or even like last year, 2022, if you don't even want to break it by sectors, break it by the style, like value versus growth. Growth went down 30%, while value went down like 8% for the year, right? That's a decent range. But you did not exceed growth dropping 30% and then value going up 15%. They kind of tend in the same direction. And if we're looking at the data here, it's like utilities, healthcare, energy, they all are trending down year to date, but you've got only 2 or 3 sectors going up 40% for the year and 50% for the year. So it is very normal that some sectors are lifting the economy. During COVID, healthcare lifted the economy out of, because people were betting on those pharma companies coming up with the vaccine. It's normal to happen. The gap of it fluctuates on a distribution, and it's kind of on the wider end. It's like the average spread usually.
So that's really what it is. It's the spread. It's not necessarily, again, people want to make it seem like this is some abnormal situation, but it's really not. You're just saying the spread is what's a little bit not normal.
Yeah. So for people who like do direct indexing or SMA, they have a higher responsibility to make sure that their portfolios are getting rebalanced more frequently given this wider spread. But for people who are holding an ETF that already incorporates the weightings within it, like the whole US market or a globally diversified fund, those are being taken care of from within.
Got it. That's awesome, Rabih. And I want it on the record one more time. I was never questioning your numbers. Never would, never will, ever. I love that you thought I was questioning your number. Like I was Googling. I was not. I was looking at the doc. Okay. moving on to retirement, the next two topics here really around the theme of retirement. Our study buddy Victoria has, of course, a study, and then I have, because I'm not nearly as deep thinking as Victoria. I just have a little dinky little article, but they go hand in hand. So I'll set this up first, and then we'll jump into your stuff, Victoria, and we'll also talk, I think, a little bit about this segment we did. I think we're going to kind of do this in pieces, right, Victoria? I'm not really sure your plan with the Dave Ramsey reaction video, but I think we're going to kind of release it in pieces.
Yeah,
maybe maybe do a full thing at some point. I don't really know. I'm going to let you do that, but
yeah, it'll be released in pieces on Instagram, and then the full thing will be up on YouTube.
Okay, perfect. So this again goes hand in hand with that. So the article that I found was from the Wall Street Journal. It was titled "The 4% Rule is Back," which I thought was kind of interesting because I'm like, where did it ever go? I didn't know it ever left. In fact, we saw some studies that came out relatively recent of the original creator of the 4% rule. His name is William Benjamin, who actually said that he actually increased the 4%. I think he had moved it up to like 4.7. But anyway, I thought this was a good opportunity just to kind of like remind people of kind of, we work with a lot of younger, what we'd call accumulators, young people who are saving money, in their 30s and their 40s, maybe even in their 50s. But I thought this was a good reminder to talk about the end, like retirement, like what should you be thinking about when it comes to retirement? So this article is talking about the 4% rule being back. And what they were specifically talking about in the Wall Street Journal was because bond yields have been so low for so long, it was kind of hurting this idea of you being able to withdraw 4% of your portfolio. They actually, over the last like 10-ish years, they're claiming it dropped to like somewhere in the 3.3% range, which I actually kind of found ironic, guys, because that's actually the number we talk about is 3.3% is what is the number we're telling our clients to be shooting for. So all that to say, again, as a reminder, the 4% rule being that you can withdraw. So you have $1 million, you can pull 40% of your portfolio without your money ever, or your principal, the actual investment account ever running out of money, right? I guess I'd say this, it's probably somewhere between a 3 and 5%. In that range, you're going to be totally fine. Dave Ramsey then released a video relatively recent where he was saying it should be 8%. And again, go to our Instagram to get our reaction to that. But anyway, I just thought it was a good reminder to say this is still very much there. 4%, I think, is still very much within that range that we'd feel comfortable in. So if you're out there wondering, how much should I be saving? I think it's still a good benchmark to use. Victoria, what are your thoughts on this?
Yeah, I think there's been just so much like talk back and forth on this. And I feel like I've heard so many different numbers like throughout my time in this industry.
We keep coming back to 4, it feels like.
And it kind of keeps coming back to that. I mean, certainly 8. I don't think there's I don't think there's much of an argument there. And if there was, like, we still just like at Dentist Advisors like to take more of a conservative approach anyways. So like, say we were wrong and you could have taken more, at least you're in a position where you still had money instead of like, oops, I overspent. So like, we will always err on that side of like, oh, you had enough and you got to live your life and maybe you had some left over versus, oh crap, I ran out of money, like, and I need to rely on family or outside resources. So even if he is right, like, why take that kind of chance?
Yeah, exactly. One of the points that Dave Ramsey said in that video that I thought was interesting, especially based on what I heard today, I'll mention this, but he said something along the lines of like, first of all, Dave Ramsey is just so bombastic and arrogant. It blows my mind. Like making fun of this guy, making fun of people for being so stupid.
He was so mean.
He was so aggressive. And maybe some people like this. I don't particularly like it. I think he goes a little far. But one of the things he did say that I actually tend to agree with is this sense of you're going to go off track, right? You're not going to really know. Like if you're 30, 35, 40, even 45 or 50, you're not really going to know, right? Like you can't know within an exact dollar amount of how much you're actually going to need. And I was actually talking, so my flight was delayed today and I was talking, they were waiting for the first, what do they call them? Not the first mate. That's like boating.
Pilot?
No, it was the pilot, and then there's the captain, and there's like the first. I think they call him like the first attendant. Anyway, it doesn't matter. So the pilot's there. We're waiting for his co-pilot. We'll just call him the co-pilot. They had another name for it. Anyway, we're waiting for him to show up, and I'm talking to the pilot, and we're talking about flights and whatever. And he says, "You know what's crazy is 75% of flights during the flight is off track. So like from point A to point B, up to 75% of flights, you're off course in some form or fashion, which I thought was so
make me feel good.
Right? But how many flights
have a safe flight now?
But how many flights, and like 99.999% of flights end up where they're supposed to go, right?
Yeah.
I guess I bring this up to say Dave Ramsey is right in that video to say you're never going to be right on course. Most of the time, you're going to probably be off throughout the time you go to retire or through that retirement journey. But again, I think it's good to have like a conservative figure of saying, what should I be shooting for? We still very much think 4% is a good number to be shooting for. Rabih, do you have thoughts on this at all?
Yes, I'm trying not to make it very technical, but the question of like what makes a 4% the safe withdrawal rate like has underlying assumptions behind of it. And the first one starting is if your portfolio value never changes and you only take 4% every year from it, it's going to last you 25 years. And if you take 3.3% out of it, it's going to last you 30 years. And the underlying assumption here, if you are invested in an asset class with a very low probability of losing money on a 25-year horizon or a 30-year horizon, you should be in a safe zone. So a 4% rule works really great for people who have equity portion in their portfolio. But if your portfolio is 100% in bonds, no, a 4% is not a safe withdrawal rate. A 4% just tells you that your money is going to last 25 years. And I'm going to twist a little bit the analogy that you said. Just like the airplane shifts from the route most of the time, the safe withdrawal rate also fluctuates with time according to the macroeconomic environment. So definitely from a risk management perspective, because you can never predict what the safe withdrawal rate is going to be at each point of time, from a risk management perspective, you just go conservative. And I'm pretty sure even when the pilots are off course, they are checking where the airplane is and how far they are from the route every period of time. And that's why it's so important in the last 10 years towards retirement or during retirement itself, you are always re-evaluating what's the withdrawal rate that I have right now in my portfolio, what am I invested in, and how much can that make last at the end of the journey.
Yeah, and I feel like life happens too. Like some years, like you're just gonna have to pull out more. Like something's gonna happen. You're not always gonna stick to exactly 4%. Some years that might be like 8, and other years it might only be 2. So yeah, to your point, like from a macroeconomic level, sure, that's gonna affect that, but also just from a personal and life standpoint, like that's gonna change.
Well, that in lies the main problem we have with that Dave Ramsey video that we're sending out in I chunks,
love how
right?
you call him Davey.
I'm sorry. I just sometimes I gotta call him Davey. It just requires it. But that's my main problem with that and his take in that video and just generally is how simplistic he views it, right? I mean, his math is so ridiculous in how he approaches this when he says, oh, you're going to get a 12% rate of return. 4% goes to inflation. You can pull out 8% every year. And I'm like, Davey, that's not how this works. To your guys' point, it's so much more nuanced than this. But I think what we're saying is if we're going to shoot for a general number, right? If you're sitting here again as an accumulator, you're trying to save up money and think about generally, let's get a direction, let's get a destination, knowing that 75 or 80% of the time we're going to go off course, but we got to start with something. I think 4% is still very, very safe to be considering. So with that said, speaking of retirement, Victoria, let's jump to yours as far as our study buddy, our resident study buddy. Will is our resident crypto bro. Victoria is our resident study buddy. Let's talk about what you have here when it comes to retirement.
Yeah, I mean, this just like ties in very well to your topic, Matt. And also, I just have to recognize I'm sitting in one of those chairs that is like slowly sinking.
just slowly dropping.
Like, I don't know if anyone watching this is noticing, but like I am like shrinking like 1 centimeter per minute, and I'm like, so sorry. But
The dream team.
I'm just as shocked as you. So.
Yeah. Rabih is so appalled by us right now.
I appreciate that she's using the metric system. The music to my ears.
It is better, I will say.
I thought you were American, but whatever, Victoria. Okay, moving on.
No. Yeah, no, I think like my topic, it's funny that we kind of picked topics that complement each other there, but really like other things that like influence like this whole like retirement and withdrawal safe withdrawal rate. Oh my goodness. Is the fact that you do not know when you're going to retire. We don't know when you're going to retire. So I just kind of dug into this a little bit more to see like how your retirement expectations influence your retirement intentions, how then that affects like your whole retirement strategy. And something that's just been consistent for like decades is people get it wrong. When you're on the younger side, like you think you're going to retire earlier, and as you age, that actually gets pushed out. So that's one truth to it. The other truth is like, I think it was 53% of participants in this one study retire earlier than they expect, and only like 15% of people actually retire when they think they are going to retire.
So you're saying either earlier or later?
Yeah, most will retire earlier. Then the next group is they retire later, and then the last little bit of people actually get it right. So people are pretty wrong about it. And I feel like factors that influence early retirement, a lot of it has to do with health. Like people think they're going to be a lot healthier for a lot longer. But I feel like these are just really important things to keep in mind as you're creating your retirement strategy and financial strategy, because odds are you're going to retire earlier. So what does that mean? Really, that means I need more money to last me the rest of my life. So that's why we really like push a high savings rate and investing early, so you have a better chance of succeeding there, because odds are you're going to need more money in retirement. So that, paired with the fact that people are living longer is, funny enough, like a problem in a financial strategy, because we need to make your money last longer. So these are things to just keep in mind as you're thinking of retirement, that it's likely, hopefully, going to be earlier for a good reason, and that your money is going to last you your whole life.
Yeah. What's interesting about this, Victoria, is that in the dental space specifically, like we talk about this all the time, right? Is like, I actually thought when we talked about this before that the study was going to reveal, like this kind of shocked me, that the study was going to reveal that majority of people retired later than they think. So I was very surprised when I saw, and as you're highlighting now, that the bigger cohort there is that they retire sooner than you think. But I think it's important to highlight here that specifically in the dental space, that dentists actually retire 7 to 8 years later than the average American. So they're
probably picking up that tail end.
which is so interesting. They're like, dentists probably are picking up that. You
guys are the rest of it.
Exactly.
You guys and the rest of the country.
It's like, I'm sorry, everyone. Sadly, everyone retires sooner than they think, except for dentists.
For you.
Exactly. But I think the key here, what you're saying, is like, you're gonna get this wrong. Chances are you're gonna get this wrong. So like,
right.
So what does that mean?
What do you do?
So I think from our standpoint, for us, at least, here's what I think about, and I'll throw it to you guys. But what I think about is this whole idea of a financial plan, this idea of like the financial plan as in a noun, like it's this thing, like I have this plan, we're good to go. That's so archaic. The idea is it's a planning process, because you're going to get this wrong all the time. You got to keep revisiting this. You got to keep thinking about, you got to keep coming back to this idea of like, what am I trying to accomplish here? And also the second part of this, I'd say, is don't get too focused on the future. Like a little, it sounds weird as a financial advisor, financial planner, but doing it the right way is planning for the future while also living in the moment, right? And enjoying what you have now. Because again, you're going to get this wrong.
Yeah. Well, I feel like what I would add to that, or the way I would say it, is like, control what you can control.
Love that. Yeah.
Like you can't really I mean, you can and you can't really control like exactly when you're going to retire. Like, but what can you actually do about it right now? You can control your savings rate. You can control like your standard of living. And I feel like that the whole standard of living is I think like a huge reason why dentists will retire much later. Cause like the higher that goes, the harder that is to compete with. And then you're competing with yourself and it's a vicious cycle. So I think that's like what I really do love that about like our approach. And I've been other places where it's like let's run scenarios for you retiring at 65. And if you do these things, then it's an 80% chance. And if you do these other things, that increases to 84%. And that's just like not real life. Like, so I love our approach of like, okay, this is what we're shooting for. This is what we can control about it to give you the best chances, and we'll adjust as needed.
Yeah. Which by the way, we're not saying that those things are necessarily wrong. We're just saying that don't get too beholden or stuck on those numbers.
Right.
It's like, to your point, Victoria, this is a probability game. But people, I think the traditional financial advisor is going to get so stuck on these numbers when you're talking to a 35 or 40-year-old. And the truth is, if we're being honest with ourselves, it's like, we have no idea. We're going to control what we can control and revisit this on a regular basis. And that's all you can really do. So Rabih, come in with your technical side of this, if you have any thoughts on this.
No, I agree with Victoria. So put that for the record. I agree with Victoria.
Wait.
Whoa, wait.
Hang on.
This is being recorded. This is being recorded.
Everybody. This might be the greatest gift I've ever received. Rabih, can you say that
Happy
one more
birthday.
time?
So what I was saying is that the technical aspect definitely does not overwhelm the common sense approach to it, right? The tools are there. They are great to make sure that within this range, it like adds up and the math clears up, and I'm not being delusional, but the common sense approach, you can control your saving, you can control your lifestyle. And if you assume that tomorrow is going to be like today, and today you saved enough, then you can survive tomorrow. And that's the common sense idea. And, I know we're like throwing darts at Monte Carlo simulations, but, the simulation is just going to it's just going to allow the numbers to make you more confident in your common sense advice. That's all it is.
Yeah. Go ahead, Victoria. Do you have any thoughts on that? Did you want to like bask in your glory of Rabih agreeing with you, or
say like, thank you?
Yeah.
No, I will take this time to say thank you, Rabih. I appreciate you.
That was so nice of you, Rabih.
I'm sure the next time we're on this, we'll both be fighting about something. So just enjoy the moment.
Rabih, thank you for throwing her a bone. The last thing I'll say on this, and Rabih, I know you'll like this. I'm wanting Rabih's approval so much now that Victoria has received it. I'm like, oh, can I have some too? No,
jealous
but yes, I'm very jealous. No, but the other part that I thought about this is, and it kind of comes along with what we've been talking about this whole time, is just how long you should be an equity investor and you don't even realize it. Like, I think that's what people don't realize as well, is when we talk about what you're going to get wrong in retirement, you're also going to get wrong how long you're actually going to, or you should be investing in stocks. I think a lot of times people think, oh, well, I'll invest in stocks until I get to this retirement age that I'm going to get wrong. And then once I'm in retirement, I'm just going to invest in like something super safe, let's say bonds or cash or whatever. No, like, because you're going to get it wrong, you're also going to get wrong how long you're going to live. Your investing lifetime is going to be 10, 20, 25 years longer than you think it is, most likely. We hope, right? We hope. And so I think that should also shift your mindset a little bit about your investing strategy and your approach overall to things like investing in stocks. So
exactly, like if you are barely retiring, yes, Matt, 100%.
Yeah, I love it. I'm so excited.
We're just here to get Rabih's validation.
That's all we are doing.
That's all we want.
That's not the purpose of this podcast, you guys.
Rabih, tell me I'm right.
Back to the point, like, if a dentist is approaching their retirement and the money that they have accumulated is barely sufficient to cover their lifestyle, they are unfortunately have to leave money on the table. In a sense, they will have to go into those safer assets to make sure that every dollar they need is there that they can approach. But given that this is a process that will last 20 years, 25 years, hopefully 30 years in retirement, and there are asset classes that give you much more money on that investment horizon, you are leaving money on the table. So it's like you exponentially improve your chances of a successful retirement if you reach retirement at a spot where the accumulated wealth so far is actually a little bit over the necessary minimum amount of money that you need, because now you have a little bit of room to actually capture higher expected returns on a decently large investment horizon during retirement.
I want to end it there. I love that. That was so good. I don't know about you guys, but I feel like this was jam-packed with just nuggets, nuggets of knowledge.
Great
Victoria.
content, and we didn't get into a fight, Rabih.
And we had fun.
We actually like played fair today.
Yes, I
and
know.
Nice.
I enjoy it. That's the best part. So, all right. Any final words before we sign off?
No? I love you both.
Oh, we love you, Rabih. Oh my God,
I love you both.
Okay, we're gonna leave it there with lots
From
of
you
love.
guys, I love this.
We should start late more often. I feel good about this. So, all right, everyone, thank you so much for listening. We really appreciate it, whether you're watching live or you're listening on the podcast over the weekend, whatever it is. We love doing this. We love bringing value to you. So we really hope it is valuable. That is our 2 cents. Until next time, we see you later. Bye-bye.